My colleague Adam has a great piece you should read in the commentary below about stall speeds when flying and what can be learned from scary situations that we might be faced. No stalling here. We're going around the world in 300 seconds. So my colleague's Adam Gelhausen's piece is going to focus on, again, stall speeds and really the emotional training that we all need to go through as investors. Great read. Hope you check it out. I'm going to take on the task of trying to go around both from a macro data standpoint and equity market standpoint around the world in 300 seconds. So here we go. In the U.S., from an economic perspective, data continues to surprise from the upside. And again, we've talked about this before. Expectations are as important or more so than absolute levels, and expectations were pretty low. Obviously, as Brian Westbury would say, the pouting pundits of pessimism were calling for recessions and had all sorts of dire, bearish forecasts at the end of last year and early in this year. Those are proven to be wrong once again. So GDP surprised to the upside, up around 3.2%. This year, durable goods came in pretty strong. Consumer spending came in pretty strong. As we cautioned you back in our piece right before Christmas last year in the height of the bearishness, when you have consumer debt to income ratios where they're at currently, when you still have the positive demographics around housing that we have currently, you rarely, if ever, see recessions. And so anything's possible. Your plan should be ready for any number of different scenarios. But again, a lot of those bearish forecasts seem to be more based off trying to scare people, sentiment, ratings, than they do a genuine attempt to give good advice. From a market standpoint, only a handful of times in recent market history have you seen a descent of almost 20%, only to have that all brought back within a 7-month time frame. We got back to the all-time highs in the S&P 500 earlier this week on a pretty strong, almost 1% gain. Bespoke did a great report where they went back and looked over all relevant time frames from 1 week to 1 year after such an event. All were positive. The 12-month number, historic average, again, ranged from everything from negative to positive, but the average has been a gain of around 7.4%. Flipping over to China and Asia, obviously there's a horrendous 2018 over there. At one point, the Chinese market was down almost 30%. Their economy was having some of its slowest growth in quite some time. Worries about their debt levels, et cetera. Trade wars with the U.S. Now we're seeing signs of a rebound. The government's starting to stimulate that economy. Some are trying to analogize it to 2016. We don't see it being quite that positive. That view is being supported recently by some of the data out of South Korea, Taiwan, Japan, on the industrial production and trade front, which haven't been quite as positive. But from a market, equity market perspective, the index is back into the black, erasing its 14% decline in 2018, up over 14% this year. So again, we think the recovery is intact in China. Should obviously, if the trade conflict comes off the table, continue to move forward. And so we look for good things out of that economy in that region moving forward. Going over to Europe, our last stop in this whirlwind tour. Obviously, it's been a lot of bad headlines, a lot of bad news out of Europe for some time. We've seen that abate a little bit with the kicking of the can of Brexit down the road. But the data continues to be mixed. Consumer spending and retail surprisingly resilient. That's obviously a huge part given the tourism aspect of the economy that's been there. But Germany, the manufacturing powerhouse, the biggest economy in the Eurozone, continues to disappoint, both from an industrial output perspective as well as a sentiment perspective. And so while we think the arrest has been suspended, as do many of the colleagues outside of 10 Capital that we work with, don't see the recovery, the rebound that we're seeing within the U.S. and Asian data. From a market perspective, it hasn't stopped equities from rallying. They've made up most of their 2018 losses, again, up over 13% year to date. We're just cautioning people that, like the economy, the market's likely to trade sideways and with some measure of volatility. So that's it. They said it couldn't be done, mostly my colleagues, that I couldn't make any kind of a salient point in less than 5 minutes. I think they actually said 5 hours. But that's it. We've gone around the world and hopefully brought some more clarity to you. Please check out my colleague's Adam's article. Check out the Weekly 10s, the podcast. Thank you for all the feedback we've gotten with that, from you on that. And with that, have a wonderful weekend.